Maya and Derek are both 27. Same job title, same $68,000 salary, same $10,000 signing bonus just hit their accounts. They sit down the same weekend to invest it. First real money either of them has ever put into the market. Maya calls her cousin who knows a guy running a hedge fund. Derek opens an app, types index fund, and clicks buy on the first thing that comes up. Same age, same money, same starting line. 15 years from now, one of them will have made a choice that quietly cost them over $100,000. And it's not the one you'd expect. Maya grew up watching her older brother turn $2,000 into $30,000 during a single hot stretch in crypto, then lose most of it just as fast. But the story she kept was the win, not the crash. So when her cousin describes a hedge fund manager who beats the market every year, it lands as obvious logic. Pay for expertise, get better results. The same way her brother got lucky by moving fast. Derek's story runs the other way. He watched his dad sit at the kitchen table for years, moving money in and out of individual stocks based on tips from a coworker, always convinced this was the trade that would finally pay off. It never quite did. So Derek trusts almost nothing that sounds clever. If it's boring, cheap, and everyone agrees it works, he's in. No drama, no story to tell at dinner. Neither of them has ever heard the term expense ratio. Neither could tell you the difference between a mutual fund, an ETF, and a hedge fund if you asked. They just know what they want. Maya wants an edge. Derek wants to not lose. If you're the type who wants to actually understand how your money grows instead of just being told where to park it, hit subscribe. That's exactly what this channel does. Real decisions, real numbers, no vague advice. One video at a time. Now, here's what each of their options actually is. An index fund doesn't try to beat the market. It just buys a slice of it. If Derek's index fund tracks the S&P 500, he now technically owns a tiny piece of all 500 of those companies. No stock picking, no manager making calls. The average expense ratio on a fund like this runs around 0.03% to 0.15% a year. On Derek's $10,000, that's $3 to $15 annually. An ETF, or exchange-traded fund, works almost identically. It's a basket of investments tracking an index, but it trades throughout the day like a stock, instead of pricing once at market close like a traditional fund. For someone like Derek, an ETF and an index fund often end up being nearly the same decision wearing a different wrapper. There's one more difference between Derek's two boring options. Because of the way ETFs are structured, they usually trigger fewer taxable events than mutual funds, even when they're tracking the exact same index. A mutual fund can pass on a tax bill from other investors cashing out, even if Derek never sold a single share. It's not a huge line item on $10,000, but it's the kind of hidden cost that becomes real money over decades. A mutual fund is where things start costing more. It pools money from investors and puts a professional manager in charge of picking what to buy and sell, trying to beat the market instead of just matching it. That expertise isn't free. Actively managed mutual funds commonly charge expense ratios between 0.5% and 1% a year, sometimes more, though the broader industry average is lower, around 0.4%. Pulled down by a handful of very large, cheaper funds. Even at that average, on $10,000, that's $40 a year, every year, whether the manager wins or not. Then there's what Maya's cousin is pitching, a hedge fund. These pool money from wealthy investors and use aggressive strategies, leverage, short selling, derivatives, chasing bigger returns. The classic fee structure is 2 and 20, a 2% annual management fee plus 20% of any profits the fund makes. And most hedge funds require a minimum investment far above $10,000, often $100,000 to $1 million or more. So Maya's cousin is really describing something she can't even access yet with this bonus. Put that fee structure in a simplified example. If Maya could access it with $100,000 and it returned 8% in a strong year, $8,000 in gains, the fund takes its 2% management fee first, roughly $2,000, then 20% of what's left, about $1,200. In this illustration, she'd walk away with roughly $4,800 of an $8,000 gain on a good year. The exact split can vary by fund. So the real lineup, cost-wise: index fund and ETF near the bottom, mutual fund in the middle, hedge fund fees stacked on top of everything else. Derek's fund owns essentially the entire market, spread across every sector. Maya's cousin's fund is betting on a much smaller set of aggressive positions, trying to outsmart that same market. The pitch is that concentrated skill beats broad ownership. The fee structure is built on the assumption that someone, somewhere, can reliably tell you which stocks will win before everyone else figures it out. 10 years later, Derek's boring index fund has ridden the market's average annual return, historically close to 10% before inflation over long stretches, compounding quietly with almost nothing eaten by fees. Maya's cousin's hedge fund had 2 great years, one brutal year, and several flat ones. And even in the good years, that 2 and 20 structure meant a big chunk of the upside went to the fund before Maya ever saw it. According to S&P's SPIVA scorecard, which tracks active fund performance against benchmarks, close to 90% of actively managed large-cap U.S. funds failed to beat the S&P 500 over the 15-year period ending in 2024. And no fund category across the board had a majority of active managers beat their benchmark over that stretch. Maya didn't lose money outright. She just paid more for less, chasing an edge that the data says is rare to sustain. None of this means active management never works. Some managers do beat the market, some years. What decided the outcome here wasn't cleverness, it was cost and time. A fee that looks small on paper compounds against you the same way returns compound for you, except in reverse. It's tempting to look at Maya's choice and call it the wrong one. It wasn't wrong to want more. It was expensive to chase it without checking what the fee structure was actually costing her along the way. The real question was never who's smarter. It was who's paying less to be patient. Every video on this channel starts the same way. Real people, real numbers, and a decision that looks simple until you actually run the math. Index funds and ETFs won't make headlines. Hedge funds and flashy stock picks will. But headlines and outcomes aren't the same thing, and the gap between them is usually paid for in fees you never see written down anywhere except a fine print disclosure. If you want more videos that pull that kind of decision apart, piece by piece, subscribe. This channel exists to help you see the numbers your gut usually skips past. Which one would you have picked at 27? Maya's edge or Derek's boring bet? Drop it in the comments, and I'll see you in the next one.